Okay, now for the latest on CIT, bailout talks between the small business lender and the U.S. government are said to have collapsed, meaning CIT could be on the brink of bankruptcy. Our next guest says that's not necessarily bad news because CIT's business model is broken. Adam Steer is an analyst at CreditSights, and he joins me now here in the studio. Adam, great to have you with us. A lot happening with CIT. In fact, their bonds are plummeting as we speak, and in their credit default swaps are soaring to records. Are we near a bankruptcy here for the company?
I think absolutely, yes. Right now there's two viable options. Either the company goes to the courthouse steps and files for bankruptcy, or it gets a bailout package from an investor. And that's possible given...
From a private investor.
From a private investor, exactly, given that a lot of its investors are distressed debt funds and hedge funds at this point. Mm-hmm. But honestly, that's like a Hail Mary pass at this point. Given what happened to other investors that sunk money into a failing financial firm when they were on the brink, such as at TPG with WAMU, mm-hmm. And other names as well. So we think the most likely outcome at this point is bankruptcy filing sometime today or tomorrow. Mm-hmm. Also, you know, if you look at the model of CIT, what do they have right now? They don't have a viable funding model because they're not a real bank. They may be a bank holding company, but... Right,
but they don't have branches on Main Street and all of that type of thing.
They don't have branches on Main Street, so how are they going to fund new originations going forward? Mm-hmm. It's pretty hard to do if you don't have branches. The only way you can raise a deposit is by going into the brokered CD market. But an unstable company going into the brokered CD market really pressures the whole financial system as a whole, because in order to attract deposits, they need to offer a very large rate because they're unstable, and investors need to be paid for that risk.
Well, and the whole reason why, though, we're talking about CIT and possible bankruptcy and why it's so important for us this week is there's a big debate whether or not it is systemic to the financial system or not. And what is your view on that?
You know, we don't view CIT as a systemic entity. If you look at their volume of originations versus the size of the retail market as a whole, annualizing their first quarter volume, that gets you to about $43 billion, mm-hmm. Versus the size of the U.S. retail and manufacturing market, which is multiple trillions. Okay. So to say they're systemic by objective measures doesn't hold water. In addition, CIT...
But yet they're a lender for 300,000 retailers, though.
Absolutely. But for any lender that has a strong credit profile, they'll still be able to get capital. Mm-hmm. Looking at CIT, they're not systemic in other ways, too. They're not a big derivatives counterparty to a lot of companies. They're not a big depositor. They only have about $3 billion of deposits. There's this very few measures by which this company would be considered systemic. There's political arguments into saving CIT, such as by supporting CIT, maybe you are supporting smaller businesses, which is a good thing. Mm-hmm. But ultimately, the question for regulators came down to, in our view, is this company systemic? Is the economy going to take a meaningful hit if we don't support it? Right. And our sense is that that answer to that question was a no.
Okay. Adam, thanks so much for joining us. Appreciate your time. Adam Steer of CreditSights talking about CIT.